Hey everybody, today we're back at OnPods Studios. We're here with Nico de Bony, and he was here before talking about his options trading strategies and general market advice for us. He does have an options trading strategies masterclass, which is called 5 Strategies to Minimize Losses and Maximize Gains, which I looked over a little bit, but I did have some more questions for him because sometimes it's a little bit more complicated than what meets the eye. So we're just going to start out with the first question here. I would love to see a live example of how you would execute a trade, like an options trade or call. Where do you go to buy an options call?
Okay, so that's a great question, and we can do a demo in another video, maybe something where I can share my screen.
Yeah.
It will be easier to see than if we were just showing it on my phone or on the TV here. Basically, I can give you the quick steps. So the first thing you need is to have a broker that allows you to buy options. Most do, but they require you to just fill out a quick form just to request the permission because they don't want people to find options by mistake and buy it if they don't know what they're getting into. So usually it's just something that takes a few hours to a few days for them to approve it. And then once it is good to go, you can start buying simple options. Usually they have like 3 levels, it's like simple, advanced, and expert. And some accounts have limitations as well. Like a TFSA and RSPs, you cannot be short, like a naked short. So you cannot sell something if you don't have the shares to back it up.
Okay.
Whereas in a margin account, you could. So that's a bit technical, but just to say that there are different levels, but you could start trading options, like simple options, very quickly, within a few days, if you know what you're doing. And then it's just a matter of going into the search bar, and usually when you type a ticker like MSFT for Microsoft, you could get the option to either buy shares or buy options. And then it looks complicated, but it's not really. It's just a filter page. It's called the option chain. And this is where you would just pick the expiration date, the strike price you want, which is the price of the contract for the execution. And then you could look at the price and see if that's something that interests you. So it's really a few steps. It doesn't take much. I'll show it because it's better if you see it visually.
Yeah.
But really, people shouldn't be thinking, oh, this is a very complex thing. Like if you have bought a share before, buying an option contract is basically almost the same thing.
Okay. Like what brokerage do you use and recommend for a newbie?
Yeah. So actually, that's a good question because I kind of moved from one broker to the other. So I started with Wealthsimple because back then I didn't know much about investing, and I like their simple approach and the way that you can start with a managed portfolio and then start trading as well. And they have the 0 commission for trading. They still convert from US. That's where they make the money. If you buy USD stocks, but if you buy Canadian stocks with Canadian money, you don't have to pay any fees. That's good. But there are a few limitations with Wealthsimple. For example, they don't show you all the options contract.
Okay.
Because some options contract are not very liquid. It means there are not very many transactions. So between the buyer price and the seller price, there could be a huge gap, and you could be overpaying or not understanding exactly what you're getting into. So when they see contracts that are not very beginner friendly, they don't leave it on the platform. Or if they do, they put a warning saying, be careful. So there were contracts I was interested in that were not available. So I moved to the next one, which was Questrade. So another company that most people know. And they have a lot more options available. I don't think I've seen anything being limited on Questrade. So this is really more potentially an advanced platform for people who want to do more things. And then I wanted to do even more automations, and I moved to IBKR, Interactive Broker.
Okay.
Because they have 20 order types. So you can really, if you want to automate the transactions and not have to look at screens all day, automate buy orders, sell orders, and things like that. This is the most advanced platform I found. But basically based on the level of the person beginning, one of those 3 platforms could be a good way to start, and they all offer options, and most of them I think offer demo accounts, so you could practice and see how it feels, and if you like the interface and all that. So
yeah, don't lose real money first.
Yeah, definitely.
Yeah. And that being said, so when you start with these brokers, you have to load your account, right? What would you say about like trying a prop firm first? Like, are there prop firms for options trading?
I think they are. I haven't used any, so I don't know about that.
Nico's too advanced for that.
No, but I started with a demo account. So it was fake money, but it was very similar to what I was going to do with my own money next. So that's why I went directly to this. And I did this after trading because I think, like I mentioned in the previous podcast, I saw people losing all their money with options. And so I really wanted to get the training first to make sure I wasn't going to do the same thing.
Yeah.
So once I started my first few trades with my own money, I knew exactly what I was getting into. Like I wasn't an expert, but I knew what I was doing. And so that's why I could get into trades quickly like this. But yeah, if people don't have the proper training, you really want to make sure that you are satisfied with your level of knowledge and skills before getting into it, because it might seem like it's very easy, but you could be surprised by the results if you don't do what you're supposed to do.
No, definitely, because I remember when I started paper trading first, and first and foremost, you have to learn the platform. So once you realize where everything is, how to buy and sell, then you start trading with like fake money. But as soon as you start trading with real money, that's when everything kind of starts to change as well. You can be doing everything properly with fake money, but as soon as you start using your own funds, like it's very psychological. So definitely think about that before you start as well. So yeah, I guess we'll get into the next question here. How much do contracts generally sell for? And is there a range based on how many shares you have?
So there's a massive range. It could be from a few dollars to $1,000 or tens of thousands of dollars. One good analogy I found to explain this is a concert ticket.
Okay.
So basically, depending on the band, like a stock, it could be more expensive or less expensive. Are you in the back or are you in the front? So that would also impact the price. And then, is it a concert that's happening tonight or is it a year from now? Because if it's happening tonight, you either sell it or you lose it. If it's happening a year from now, it has a lot of value because between now and then you could resell it higher than what you paid for.
Right.
So this is the things. Like there are four main things that would affect the price, but they're a bit more advanced. So I'll just give a quick explanation for people who are wondering. The first one is the easier to understand. It's called intrinsic value. Most people have not heard the term before, but once I'll explain it, you understand. Basically, if you have a contract where you can buy something for $100 that is worth $105, there is at least $5 of intrinsic value.
Right.
Because you could buy it for 100, resell it immediately for 105, and you make $5. So that's the minimum value. Then you add the time value, which is like the for the concert, the 1 year from now. So that's the expiration date. So if you have a contract that's for 6 months, it's going to be worth more than a contract for 2 days.
Right. Okay.
So those are the two main that are easy to understand. The third one is harder to understand. It's volatility. So the official term is implied volatility. This is basically what the market thinks the stock could be moving within that expiration period. So if a stock typically moves 20% a year and you want to buy an option good for a year, well, if you buy an option within that 20%, it's going to be more expensive because the market expects that there's a good chance it's going to be moving within that 20%. However, if you buy an option that's like 30% growth or 40% growth, then it's going to be much cheaper because the market thinks there's no chance it's going to happen. Or not no chance, but like it's very low in terms of probability. And the last one, which most people don't need to worry about, is the interest rates. So the central bank set interest rates, and that's the risk-free rate. So if you can get a risk-free rate of 5% or 4% on something, this impacts the price of an option contract as well. But for most people who don't buy options long-term, it's not really something to worry about, but it's just something to keep in mind if you ever want to buy options for like a year or 2 years, which is something I do. So
Nice. Okay.
things to keep in mind.
Yeah, that's great. Okay, so that's how the price of the contract is determined then.
Yeah.
Okay, so
Well, there's another thing. It's so that what I described was the rational portion of the price.
okay.
There's the irrational portion of the price, and that's the fear and greed. So sometimes you can see option contracts that have a price that doesn't make even sense, and that's where you have either fear or greed affecting the price, or fear affecting an insurance contract if you want to protect the downside, or greed if you see a stock price going through the roof, and options can multiply like crazy. For example, last year, I bought a contract for MicroStrategy before the big rise,
Oh, right, yeah.
and my option contract I did like a 10x in 2 weeks.
Oh my God.
And so I sold it too early in theory, but
Well,
because I never thought it was going to be that fast.
yeah, you never
But
know where it's going to go.
People were just going crazy after MicroStrategy. Back then, it was during the euphoria after the election in the US. And it was one of the few companies that was a Bitcoin company.
Yeah.
And so everybody was going after them, like both retail and institutional. Nowadays, you have a lot more companies buying Bitcoin, adding them to their balance sheet. So there's not that, one exit door where everybody's trying to cram to. So it's not, that's why you don't see as much movement on stocks like MicroStrategy. But just to show you an example of sometimes an option contract can just go through the roof for no reason because just people are going crazy in one way or the other. And so that's something to keep in mind as well when you're looking at options. And
Nice. Yeah. So I guess it really helps to have some general insight into what is going on with the company, right? Okay. Yeah.
yeah, so you can look at, does it make sense? And also to look at indicators for sentiment. So I look at indicators to see if retail investors and institutional investors are into FOMO or,
Yeah, they
I
have
think.
fear and greed
Yeah,
indicators too, right?
Yeah,
Okay.
so you can see where their head is at and how they might behave, and so that can give you a clue of, does it make sense to buy now? A funny indicator, Jim Cramer is usually a very good inverse indicator. So whatever he says, usually the inverse happens.
I've heard about that.
And
Yeah.
a few days ago, he was like, Palantir is the stock to buy, and then just it crashed like crazy. And I've seen this happen like so many times. But yeah, I use it as another one of, a soft indicator for sentiment. When Jim Cramer says buy, usually I sell. So
Yeah, that's funny. That just goes to show how emotional it actually is too, right?
Mm-hmm.
It's just like so many people think the same things, and when you actually see that in the market, that's crazy. So that's really neat. One of your strategies is getting paid to own your favorite stocks. How is this different than a dividend?
So it's different in several ways. The first one is a dividend is for all the shareholders, and it's not on your schedule, it's on the company schedule, and it's not mandatory. Like a company can stop dividends anytime they want. Some companies have done it recently, like Walgreens in the US.
Okay.
Was a very popular dividend stock. And after, I don't know how many decades of paying dividends, they just stopped because they were not profitable enough to give a dividend.
Yeah.
And so people were really not happy about that because they've been told for years, buy it, it's really cheap. They keep paying dividend, they keep increasing it a bit, but you're never guaranteed to get it. The other thing is that when they pay you a dividend, the stock price drops by the amount of the dividend.
Right.
So if the stock is worth $50 and they pay you $2 per share, the next day the stock is going to be worth $48. In theory, that's the theoretical price.
Okay.
So once you receive a dividend, the stock price drop. There's no guarantee, and usually they don't do as well as growth stocks.
Okay.
So I understand why people like the, receiving money regularly from a stocks, but from my personal experience, it's not the best approach. There are times in when it makes sense, but right now I think it doesn't make sense. Another important criteria for options, so to collect the rent money with my strategy, is that you do it on your schedule. So you can choose whenever you want to do it, and it's extra. And if you set the price higher than the current price, you benefit both from the growth and from the premium you receive, which is like a bit like a dividend.
Okay.
So it's really different. There are much more advantages to doing it with my strategy. The only caveat is that you need at least 100 shares because an options contract is good for 100 shares. So you could have more than 100, but you need at least 100. And that's the covered part of the covered call strategy I teach.
Is that for every options?
So most option contract are for 100 shares. There are a few exceptions. For example, at some point I bought a contract on a stock that went through a stock split. And so then they modified the contract. So it's either not good for 100 shares, but for the split. So in my case, it was only good for 20 shares because they split the stock in 5.
Okay.
But it could be the other way around where one contract is suddenly good for 1,000 shares instead of 100 shares. So the only thing to watch is if there's a stock split that can affect your contract, and you have to look at it and see what you want to do with it. And it can be confusing when you look at it in your portfolio because they don't change the name.
Okay.
So you might see, oh, it looks like it's good, but maybe it's not profitable, and so.
Could you actually explain that a little bit more? Because the company will choose when to do the stock split based on the value that they think the stock price is, right?
Yeah, so sometimes when the stock price is too high or too low, it's not good for them.
Right.
Most people, they seem to like buying a stock between $50 and $100
Okay.
per share. And so if you have a stock that's like $3,000, like Amazon a few years back, nobody's going to be able to buy a full share.
Yeah.
So you're rejecting a lot of people in the market who could be buying your stock. So that's why often when the stock get above $500 or $1,000, Usually they do a stock split to reduce it. And the other thing is true as well. If the stock drops too low, like $1 or $2, people see it as not like legit.
Okay.
So sometimes they will do a reverse stock split where they'd say, okay, a share is 10 shares become a share, and so you still have the same money in your portfolio. It's just if you had 100 shares before, now you have 10 shares, but they are worth the same because the price increased.
Right.
But this affects the contract because when you bought the contract, it was for 100 shares at this price. So they just tweak the price of the contract, so it's no longer worth 100 shares
Okay.
at the price of the contract. It's either they change the price of the contract or they change the number of shares
Okay.
to ensure it still match your original idea.
Okay.
So if you're right with your original idea, you will be right after the stock split.
Okay.
It's just if you're not right before and then suddenly you think you're right, you might not be. And so if you try to execute the contract, you might be losing a lot of money.
Okay.
I almost did that once. So
Okay.
I
Yeah.
called the equestrian. I was like, I want to execute the contract. They're like, are you sure? I'm like, well, it seems to be in the money, like profitable. They're like, no, it's not because of this. I was like, oh, okay, well, good thing I talked to you. So,
Yeah.
it's one of those things where I didn't make the mistake this time, but I could have lost like $10,000 if I didn't talk to that person.
Wow.
So yeah, it's the only exception where you have to really be careful and understand what you're doing if there's a stock split. Sometimes what people do if there's a stock split announced, they just sell the contract to get rid of it, and then they buy a new one once the stock split is done because it's just so much easier to manage.
Okay.
So that's what I would do in the future if I ever had a contract for a stock that's about to have a stock split.
Yeah, that makes sense. It's easier than having to like go over everything with a fine-tooth comb.
Yeah.
Yeah. Okay, so agree to sell shares at a price that you choose is something that you mentioned in your video. What would you have to do to, okay, sorry, you would have to own all the shares to purchase this additional option, right? I think this is what I'm trying to get into. For me to wrap my brain around the fact that like you have to purchase 100 shares seems like kind of a lot. Is there a way that you can manage this? Like, maybe could you purchase lower price stocks? Like,
Yeah, so I have a good example. If you wanted to buy Microsoft, right now it's about $500 a share. So if you wanted to buy 100 shares, it would be $50K.
yeah,
So that's not
I
good.
got that.
Yeah, most people don't even have that much money in total, and put that in one stock would be like crazy.
Yeah.
For bigger portfolio can do that, but most people don't. So yeah, it works for like smaller amounts per share. So if you have like a stock at $20, it's $2,000 for 100 shares. So that's more doable. But yeah, you need at least 100 shares to be able to sell the right to your 100 shares. That's the idea. And so, for example, if you bought those 100 shares at $20, you could say, if it's going to $25 within the next month, I'm willing to sell it.
Okay.
And so you would get that premium, like dividend, right away. It could be like, I don't know, $200 or whatever. So you get it right away. You can spend it like it's yours. And if the stock hit that $25 within the next month, you are forced to sell the shares, which is why you have to have them. And then you make a profit on selling the shares, $5 per share, so $500. So you're happy because you receive that $200 premium and you receive the profit from the shares. And if the price doesn't go as high, you still keep the premium you received, and you can do that every month. So that's a way to generate extra income if you already have shares that are not doing much for you. Like this is really good if a stock is going nowhere.
Yeah.
Like I did that for with gold before the big runoff, so
Right.
2 or 3 years ago. Gold was just in a range, going nowhere. So every time it would go to the top of the range, I would sell calls to get the premium, and then it would go down. I would buy back the call for nothing
Yeah.
and redo it every month, and that's how I generate income on gold, which is not paying a dividend, but I
Right.
was able to generate a dividend from gold
Nice.
because it was going nowhere. So there are many ways to use this, but yeah, you have to have the cash to buy the 100 shares, so it works better for smaller stocks.
Okay, I think I'm starting to understand more why you need to have the shares, because it's like you said, one of your analogies is that it's insurance on those shares, right?
Yeah.
So yeah, okay.
Well, so it's a small insurance, like it's not the full insurance that with the put option, but
Okay.
it's a small insurance because, so let's say you have the $2,000 worth of share. If the stock price drops 10%, you don't lose money
Okay, yeah.
because the $200 you receive is the 10%.
Okay.
So it's a small protection. But if it goes lower than the 10% drop, then you start losing money. So it's a small
Okay.
protection that can turn into a profit, but it's not the full protection that the put option would give you.
Okay.
But it's a first step. Like if you have shares and you're not doing anything with them and you want some extra protection that could generate dividend-like cash flow, that's a good option.
Okay, nice. How do you control high-priced stocks with call options?
Okay, well, that's perfect because that's kind of related to what we were talking about. So let's say that you wanted to buy the shares of Microsoft. So you don't have 50K?
No?
No. But
I
maybe
wish.
maybe you would have 6K.
Okay.
And so I looked yesterday at that. So you could actually buy a contract for $6,000 that would be good for a year to buy the shares of Microsoft at $500.
Okay.
So one person could be putting 50K and have 100 shares of Microsoft. You could be putting 6K and have the right to those shares. And so if the stock goes to $1,000, you get most of the upside, but you only put 6K. The other person, they put 50K.
Right.
And so,
How much would you get if it went to, you said 500 to $1,000?
yeah.
If you put down 6K, what would that percentage indicate?
Percentage would be massive.
Like you would get the whole increase on,
So you would get 1,000 minus 500.
right?
So that's 500 times 100. So you get 50K.
You would get the 50K
Yeah.
with just $6,000.
6,000. Yeah. So both you and the other person would get the 50K,
Right.
but you only pay 6K. So your net would be 44K
Right.
versus the one with the shares, but your capital at risk was so much lower, which is why I think it makes so much sense for most people. Even if it's not about I cannot buy the shares at 50K, it's just I can reduce my risk and get most of the upside.
So yeah, now that I'm thinking about it, the stock going up, that's literally 100%, right?
Yeah. So that's why I
Yeah.
used it because it was easy to do the math.
So like I'm thinking, can you do that with crypto as well? Because crypto
Yeah.
definitely, 2X's all the time.
Yeah, I've done it several times.
Oh my goodness.
Like in April, I bought some calls on Ethereum
Uh-huh.
for $50.
Yeah.
I resold them for $5, so that's a 10x in 4 months.
Yeah, okay. I'm starting to see where this is valuable for, I understand, I don't understand
Mm-hmm.
crypto per se, but I understand the volatility more than, these regular market stocks right now,
Yeah.
I think. Like, there's a lot going on in crypto, so, I
But
feel
if
like
you think
options
about
would
it,
be-
someone who just bought the coin or just the regular shares,
Yeah.
they doubled their money.
No,
I
exactly.
did a 10x with less risk. So that's why it just makes sense. Like it's not a guarantee, but it's like when it works, you can make your year of investing in like a week. So
I just got really excited. Okay, cool. Okay, so
yeah, that's my favorite part of options is about getting most of the upside with very little risk. Like I can't believe I didn't know about this earlier. Like,
yeah, totally. Especially if you really are confident in a stock, and if you are confident enough to put your money in a stock to begin with, why not also put it in an option?
yeah.
Like you said, there's a lot of upside and it limits the risk.
And if you do with a long-term option, there's plenty of time for you to change your mind, and so you don't lose the whole thing.
Right.
Because the time value is so big that at the beginning, if the price of the stock or the crypto doesn't move, the option contract doesn't move either. So you could be buying a contract, and a month later you're like, maybe I'm not so hot on this stock or crypto anymore, and you just resell it, and
Yeah.
no harm, done. So it's
Nice. Okay, cool. Okay. What are your criteria to finding stocks that you're going to invest in?
So my approach depends. I invest both for the medium term, so like 1 to 2 years, for like big themes, like AI or infrastructure, like for all the electricity the AI needs, or commodities or crypto, things like that. So for this portion, it's very different than for the swing trading portion I do. So for the long-term things, first I look at the macro data. So I analyze what's going on, in the world that could affect big trends. And then I look at the technicals to see if stock or crypto or commodity makes sense. And then as a last step, I kind of look at some like fundamental analysis, the old style of looking at the companies.
Yeah.
So is the company profitable? Are the revenues growing? Are the earnings growing? That kind of thing. But that's like my last step, just to do a triple check before investing my money. But the most important thing for me is look at the big trends.
Okay, nice. And I also have something to ask about because that's like financials, right? Financial ratios. Is there any red flags that you see in a company's financial ratios that don't match up to the story, or just in general that you look out for?
Yeah. So for example, that's why I try to avoid investing long-term in companies like NVIDIA or Palantir, because their ratios are so high, like it's higher than the 2001 bubble
Yeah.
in tech.
Wow.
Like their numbers don't make any sense, and it's impossible for them to continue growing at that pace
Right.
forever. But the market is pricing that right now.
Yeah, it's very
And so
inflated.
that's why I'm like, this could fall any day. And Palantir has been falling crazily over the past few days.
Yeah.
It's not the fault of Jim Cramer. But, it's just to say
He
like
just helped.
those companies, it only takes a small thing to just crumble the whole thing. So
Yeah.
that's why when I see a price to earning ratio or sales to stock price ratio that's so high that it doesn't make sense, I try to avoid them, or it's a very short term, like 1 day, 2 day, a week trade, just to benefit from a rebound or something like that if it's like oversold.
Okay.
But I try to avoid the companies where those fundamental ratios don't make any sense, are so far from the reality that it just doesn't make sense. When people tell you just buy it because it keeps going up, it's not a good reason.
Yeah, that
So,
sounds scary.
yeah.
Yeah. Yeah, buy low, sell high, guys. Come on.
Yeah, and to finish the answer for the investing part, so for my swing trading thing, so that's usually trade between a few weeks to a few months, I almost exclusively focus on technicals.
Okay.
Because I don't really care if it's a good company or not. I'm just trying to see where the momentum is, because there's really that thing that's hard to explain, but if a company is going up, there's a very good chance it's going to continue to go up until a blow up stuff,
Okay.
Same thing if a company is going down, people might be saying, oh, it's a good value, blah, blah, but usually it goes on, it continued down for years.
Okay.
So there's really that momentum trade that works well for swing trading. So that's what I do. But yeah, for that portion, it's really only the technical to catch most of the upside and get out as soon as it breaks some technical indicators I'm looking at, like, moving averages or things like that. So it's two different approaches. It's like the
Right, yeah.
investing where you take more time. It's usually bigger positions.
Okay.
And then the swing trading, which is more like tactical investing when I see opportunities. And it's usually a smaller portion, like 1-2% of my portfolio. So if I'm wrong, it's not a big deal. But if I'm right, those can pay off big time. So
Yeah, nice. Okay. Yeah, because I did want to know about the technicals. When you say that, it's like the financial indicators, right?
yeah,
Like, okay. Which I feel like I would love to see that.
yeah, I'll
on-
show you some of them on TradingView when we do the demo.
Okay, nice.
I'll try to pick the easiest one to understand and
Yeah.
not have the screen like we see some people with like, too many indicators and you don't even see what's going on.
Yeah, totally.
But yeah, I try to keep it to just a few day to day, and then I add a few when I need it. And this is something that people can replicate easily because TradingView is free.
Mm-hmm.
You might be limited in number of indicators you use at the same time on a free account, but you can still activate them one at a time to check them out and put alerts. So,
Yeah, it's a good place to start for
Yeah.
sure. So put option contracts, let's get back to those.
Mm-hmm.
They give you the right to sell shares at a certain price before a certain date.
Yeah.
Can you elaborate more on that?
yeah, so this is the closest thing you have to an insurance contract,
Okay.
basically. So it's a bit like getting insurance for your car, your home, but better because you don't have to worry about negotiating with the insurance company to see if it's covered or not. And so
Yeah.
it's a guarantee, like as long as the whole financial system doesn't collapse, you should be paid, and there's someone in the market who will buy you shares at the price that is set in the contract.
Okay.
And so that's why people buy those, because it's gives them peace of mind that whatever happens in the market, they are protected. And one of the things I like about the put option contract is that you don't need to know what the market is going to do or even worry about it. Like whatever happens, you're covered. So worst case scenario, you'll be at the same level or whatever price level you choose at the expiration date, and then you can just buy another one and you can just keep going like this.
Mm-hmm.
And so people might think it's only good for people in retirement who need to protect whatever they've accumulated.
Mm-hmm.
But if people start investing now or a few years ago and they lose everything in a big crash and then it takes 10 years to recover,
Yeah.
put option could have saved them portfolio as well. So, and the best and the worst part about put options is they are the cheapest when people need them the most,
Okay.
just before a big crash.
Yeah.
Like right now, actually, well, not right now, but a few days ago, they were at the same price, like at the cheapest price you could get basically for the past few years.
Okay.
Just like in December last year when I bought them as well, in anticipation of the April crash.
Right.
Or so every time I see put options being so cheap because nobody is buying them, like I'm loading up on them.
Yeah, that's when you have to really think about like, why is this the case? And the next step
Like-
is buy because,
It becomes a no-brainer.
Yeah.
Like you can protect your portfolio for 3 to 6 months
okay.
for like 1% of your portfolio in terms
Yeah.
of price.
So why
think
not?
about it. Like the stock market has been growing like 20 to 30% per year, and you're not willing to put 1% to protect it. Like that doesn't make sense. But people are so greedy, and they are so like only with seeing, oh, it's only gonna go up, like, to the moon. They don't even stop to think, is there something I should do to protect my portfolio? They overextend themselves. They borrow money to invest, and so it's kind of sad. But yeah, if people realize it, like this is a gift because you get the insurance at the cheapest price when you need it most.
I feel like sometimes people fear what they don't understand, and this can be a little bit complicated. But
It feels like almost too good to be true.
yeah, no, exactly.
I had people telling me that, like, oh, this is too good to be true. I'm like, do your own research, or like get a call with me. You'll see, like, this is real, and people have been using it for years. Usually, it was more like people on Wall Street and the experts, but anyone can use it, especially nowadays. That's so easy, and that most broker offer it. So
Nice, for sure. So yeah, definitely look more into it, get more information, get as much information as you can because these things actually help, right? Yeah.
Well, and I think people often say, oh, it's expensive to get those and you're going to eat into your growth. But
What happens if it crashes? Then what about
but
your
people
growth?
don't think about it like this for their home insurance or car insurance.
Yeah,
Like you don't buy it because you want to use it.
yeah.
You buy it because it might save your ass. So
Yeah, no,
that's
for sure.
pretty much what it is.
Yeah. So you mentioned in your video that stock prices soar and crash. What kind of businesses or economic climates are present to facilitate this?
So there are many reasons why we've seen an increase in volatility since 2020. Big shift in the economy can create this because it makes some companies big winners, some company big losers. Like think during COVID, Zoom to the moon, and airlines to the ground.
Yeah.
Basically. So things like that can really affect companies, but sometimes they go up as fast as they go down. And so, for example, Zoom never recovered even close to their all-time high, which was probably 2021, I think. So it's really risky to go on a trade like this, and many people got caught because they bought at the top, and then the stock has lost like 80% of its price since then, and they're stuck in the trade, and some people give up. But yeah, it might never go back to that high because it was all FOMO driven. It was about an economic change that was short-lived. It wasn't a permanent change, even though people are working from home more and more. Zoom is not getting all the attention, just like NVIDIA right now. NVIDIA is getting all the attention. I'm pretty sure within the next few years, it's going to be spread out between a few players that will get more money than NVIDIA in terms of percentage of the new money. Because as a company grows, it attracts other people who can, find them on their own territory and grab shares. And so it's, but yeah, the big changes that we're seeing and the increased participation of retail investors is really changing the dynamic, and people have more money, more time, more access to cheap credit to borrow to invest,
Right.
more access to an app on their phone that they can buy stocks on, which was not so much, well, it was an option, but it wasn't very popular, 5-10 years ago. So you have all those things together that really create an environment where the volatility is increasing. And so you have those big spikes, both for the price and for the options. But for the options, it's even more because if a stock goes up 5%, the option could go like 200%, depending on where it is. So they amplify the volatility that you already see in the regular stock market.
Yeah.
And so that's why you have to be careful. But if you know how to use it properly, you can really take advantage of it. Like, for example, when I buy the put option insurance contract, I usually buy 2 of them, even if I need one, because I put a sell order to automatically sell the second one as soon as the price double of the option contract.
Okay.
This way I get free insurance.
Right.
It doesn't always happen, but 80% of the time it does.
Okay.
Just because, there might be a day where the stock drops 5%, everybody panics. And so suddenly my put option contract is so valuable and people are willing to pay twice what I paid maybe a day ago for it. And so I'm able to get free insurance. And so, it's just an illustration of how volatile the thing is, that most option contracts usually will double in price. Like if you take a big index like, the SP 500, the NASDAQ, whatever, like just a 5% drop in a week can be enough to double the value of a put option.
Yeah, definitely. So for anyone investing in stocks, okay, because sometimes, like you said, people will buy at the top. What indicators or steps would you recommend someone take so that they don't buy at the top? Like, how do you know it's the top? You never know it's the top. One, it could keep going up, but two, like you said with Zoom, like it was really inflated. Everybody was buying in. A lot of people bought the top. Like, how would you know it's that inflated?
So you never know for sure, but there are indicators, especially when you combine them together, that gives you a pretty good chance of what's going to happen. So just to give you a few examples. The first one is if it's really far from the moving average,
Okay.
there's a tendency for the price just to go back to the moving average once in a while. And so, for example, a week ago, I saw that the SP 500 was very far from its moving average. And so that's why I told people, like, there's going to be at least a 5-10% pullback in the next few weeks and months because it cannot stay that far for that long. At some point, you run out of buyers and the thing just at least go back to the average. It can go lower. Sometimes there's panic. But that's one other thing. The other thing is when you see that the movement has been going on for a really long time, eventually you run out of buyers as well. So the thing will start to roll over and you can see the price going down below the moving average. And usually that's a sign that the momentum is fading.
Right.
So the risk is increasing. Another thing I look at is it's called Fibonacci sequence.
Okay, yeah,
You heard of it?
I have.
So basically, most of the time, the stock market, and you can look at this at long-term, short-term, medium-term, like it works every time. The stock market usually does like 2 steps forward, 1 step back. And usually the retracement is about, most of the time, between like 40% and 50%.
Okay.
So if you see that the market has done this and this, there's a good chance the next move is going to be this.
Okay.
Just probability-wise, and most of the time it works well. So if I combine, all these indicators plus others that I use, I get very good confidence into what the stock market is going to do next. Sometimes I'm wrong, but like 80-90% of the time I'm right in the general direction. Not always the timing, because that's the hardest part to get.
Yeah.
But the general direction, I'm good, which is why, for example, for the past 2 weeks, I've been selling and telling my clients to maybe think about selling some of the crypto because I saw that the new all-time high was really weak.
Yeah.
And that we were getting at a moment where the risk reward wasn't as good. It could take off today or tomorrow. But I was just saying for the past 2 weeks that the risk reward wasn't very good. There was as much upside as downside. And so if you know that it can go between 120 to 130, but as low as 110 as well,
Right.
you're like, this is not a good time to put money into it. So maybe take a bit of risk off the table and wait for a good signal to go back in. Another thing that we see often in the stock market is the price will go to a new level, then goes back down, and then it goes back up a bit. And so it's much more interesting to buy at the second time it goes at the price than the first time.
Okay.
Because it's like a confirmation that
Right.
this was a real move, not a fake out.
Yeah.
And so if you buy the first one and then it goes down, you're like, I'm selling it. It's not going up. And then it goes up because all the people who wanted to sell sold the weekends. But if you wait for some good indicators that the probability are on your side, you won't always be right, but at least most of the time you will have what you're looking for. And then put in your stops right from the start. So if you're wrong, you're getting out with a paper cut, not a portfolio being destroyed.
Yeah.
So that's kind of what I look at.
How do you place your stop losses based on your risk to reward?
So this is a stock by stock or crypto commodity. The first thing I look at is what is the average variation in a day or in a week for that stock. Because if the stock is moving at least 2% per day, if you put your stop less than 2%, you're very likely to be stopped out on the first day.
Yeah,
So it doesn't make sense.
Yeah.
So I try to look at what is the average and to have a stop that's lower than this. I look at the strong level for support and resistance as well.
Okay.
If there are price gaps as well, they tend to be filled.
Right.
So I might put the stop below the gap to make sure that if it goes back down, goes back up, my stop is just a bit below.
Yeah.
And so if I'm wrong, at least I get out. But if I'm right, it just does this and go back up, I can stay in the trade. So it's really an approach where you try to avoid getting out too soon, but you also protect your portfolio and you say, okay, worst case scenario, I'm ready to lose 7%, 10%, whatever on that trade. And then you can manage this. And if you're right, you can ride it for a long time and regularly move your stop up. So the worst case scenario is you have some profit, you're not back to the step one.
Yeah, that makes sense. 'Cause
I don't know if you use moving stop loss, trailing stop loss.
I don't. I haven't gotten to that on TradingView. I don't think I can on TradingView.
Um,
We'll have to look
yeah,
at that.
because
But-
I've used TradingView to place some trades by connecting either to Questrade or IBKR, so I was able to do it. But
okay, he'll have to show me how to
but yeah,
do
this
it.
is another gift, the trading stops, because you don't have to constantly moving manually.
Yeah.
So you can just set it for a percentage or an amount below the current stock price, and it's just going to move up with you. And on
Nice.
some days, this has really saved me, and I was able to catch like almost the top
Yeah.
of a move like this,
Right.
just because I didn't have the time to watch the market. So I was just like, okay, put it like $1 behind the price, and the thing just went crazy like this, and then it went down $1. I sold it, and then it just crashed.
Right.
And so I was able to sell close to the top automatically without looking at it.
Yeah, that's the thing about a stop loss, right? Like you put it so that one, like you don't lose a certain amount of money, like your loss is capped.
Yeah.
But the other thing is that if it is trailed, you still make a profit if it kind of hits up to one of your target limits, right?
Yeah.
But once it hits the stop loss, then you still have a profit.
Yeah,
Okay.
that's the idea.
Yeah, nice.
The only thing to know when you're using stop loss is that it doesn't have the guarantee that the put option has.
Okay.
So if the stock opens below and there's a gap
Mm-hmm.
and you have a stop loss, you could be losing a lot of money.
Yeah, yikes.
Like there was a stock, the United Health thing.
Okay.
You heard about it?
I haven't.
Oh, okay. So thankfully, I bought a contract on this, not shares, before the announcement when the stock dropped 50% the next day.
Mm-hmm.
And so I lost my contract. But if I had put shares and put a stop, my stop would not have protected me and I would have lost 50%.
Right.
Because the order is basically sell at the next price, whatever it is.
Mm-hmm.
So if the next price is 50% lower because of some big news, you will lose a lot of money. So that's why I prefer to trade with options than shares, because even though it's a bit more expensive sometimes to do it this way, at least you don't have to worry about a 50% drop and being stuck with it type of thing. But yeah, it's useful most of the time. It's just you have to know what you're getting into. And I think most people don't even understand that this is a possibility. They think I put my stop loss at minus 10%, so that's the worst I can get. No, you could actually get 0%.
That's what I thought.
If the company gets bankrupt and the stock is zero tomorrow, like your stop loss is not a guarantee to sell. It's just a guarantee that your broker will send an order to the market saying, I'm ready to buy at any price.
Okay, wow.
So yeah, just something to keep in mind.
That's good to know, yeah.
Yeah.
Okay, so proxy hedges is another thing you mentioned in your
Yeah.
video. How can you guarantee the stock is qualified or designated to be under a certain sector? So maybe explain that a little
Yeah,
bit.
so there is no guarantee. So the idea here is that sometimes you have a stock that is not tradable for options.
Mm-hmm.
Could be for a number of reasons, but sometimes there's just no option on that stock. So the example I use in the video is that if you are buying a new tech company and they don't have options, well, you cannot really get that protection for this company that you bought, but you could get a protection if something happens to the whole tech sector.
Right.
And so that's the idea, that you can get some protection. So if something major happens, let's say, NVIDIA burns down, like the whole company is done, there are no more GPUs.
Wow.
Well, this would affect every tech company, right? An AI company and all that. So if you had a put option on the tech index, like the NASDAQ, you would still get some cash back from that put option, like some profit that could offset the losses on your stock.
Okay.
So you're not getting a zero protection for your stock. Let's say you lose 50% on your stock, but maybe you earn like 30% or more on the put option. So that kind of offset the losses. Sometimes it can be even more. Like if there's a real panic, you could be making more money on the put option than what you lose on the stock.
Right, okay.
But there's no guarantee. It's harder to gauge in advance. It's just something you can do to get some protection, which is better than nothing.
Okay, that's what I thought. Well, what I thought, because the way that Nico describes it is that when you have a log cabin in the forest that you can't get insurance on, but you can get insurance on the whole forest, get insurance on the whole forest. So if that burns down with your log cabin, at least you'll be getting something back.
Yeah.
So I didn't know that it was specifically for, it's just for offsetting the losses, right?
Yeah.
On that one
Yeah,
stock.
so
Okay.
that's the idea. And the good thing about this is that it doesn't have to be in the same account.
Right.
So
Oh,
for
okay.
example, you could have your shares, well, because one loss offset the other gain.
Yeah.
So you could have your share in a different account, and then you could buy a put option on a different account. And so you would have a gain in one account, a loss in one account, but your overall wealth or portfolio would be, kind of the same. So
Right. Okay, cool. So what is an inverse ETF? Like, can this be used as a day trader? This.
Yeah, so this is something that in theory was built for day traders because over time it loses value because it resets every day. So I don't want to get into the too technical for the audience here, but
Yeah.
but basically, yeah, it's good if you think like it's an easier approach than buying a put option for someone who doesn't know option. So maybe that's like an intermediate step between doing nothing. Like if you really have a good conviction that the market is about to tank, buying an inverse ETF could pay off big time. Both if it's a regular inverse or a leverage inverse, which is something we see more and more.
Okay.
So, for example, there are many like 2x or 3x inverse ETFs. So if the market drops 5%, your money in that ETF would go up like 10 or 15%.
Okay.
So that's, and they use put option for this and other tools. But so yeah, it's an easy access tool for people who don't know about option or cannot use option for one reason or another. But the main mistake people do is they buy it for the long term when over time it doesn't make sense because if you buy it when the stock is at a certain price and the stock goes up, your inverse ETF is going to melt.
Yeah.
And at some point, if the stock goes back to the same level, your inverse ETF will not be back to the same level when you bought it. So you will still be at a loss because of the daily reset.
Okay.
So this is really something that works for a few days, a few weeks at most, for people who know what they're doing. But it's not something I would recommend, as a regular thing. Like for example, in April, when there was the big crash, it was very popular, and that's one of the things I look on Google Trends. It was at the peak. Everybody was looking for inverse ETF, which is why I had a good idea that we were at the bottom. Because when everybody thinks the market is going to go down, usually that's because everybody who wanted to sell has sold, and
Yeah.
so
Everybody's getting ready to sell.
yeah.
Okay. So how is that different than like a short position? Because you're betting against the market, right?
Yeah, you're betting against the market, but it's like you're buying shares, so you are putting more capital at risk.
Okay.
And if you're wrong, it's gonna eat up your money very quickly. So you can get out. Like it's easier in a way because you're only buying like a share, not a contract with 100 shares and all that goes with it. And there's no expiration date. So in theory, you could get more time for your thing to play out. But the more time you wait, the more you lose on that mechanism.
Okay.
So like there is a reason why they created mostly for day traders, because if you get out the same day, you don't have the downside of the daily reset.
Yeah. Okay. Yeah. Daily reset. I didn't know about that. Okay, cool. Well, thank you so much. Is there anything you want to say that we haven't covered today that you want to point out, or?
So one of the things that I see as a common mistake for beginners is they usually don't have an exit plan.
Okay.
And so that's something that I think really most people, before they get into a trade, they should already decide what are the conditions that will make me exit my trade, either in profit or in loss, or at the same level if nothing happens. Like if you buy a stock and you think it's going to go up like super fast and nothing happens for 3 months, leaving your money in that trade is a lost opportunity because there are always better options for your money. That's one of the questions I get sometimes. People tell me, oh, this is a great opportunity. Why didn't you get into this one? I'm like, because there was a better one. And my attention cannot be divided between 100 positions. So I try to keep it between 10 and 15 positions because it's easier to manage, easier to follow. There will always be opportunities. But yeah, it's something that most people don't do. They only plan and think about the best possible outcome. And if nothing happens or a bad outcome happens, usually they hold on to losing trade for years.
Yeah.
And when the best thing was to exit. So that's one of the things that I wanted to share in terms of like common mistakes that beginners make.
That happened to me when I first started. Like I had a Questrade account. I bought a whole bunch of stocks. I was like, I really stand behind these companies. And then, they went down and they went down. I was like, you know what? No, the business will come back with a vengeance. Did they? No.
Yeah.
So yeah.
I did the same mistake. I think everybody does.
Yeah. It's
but
a rite of passage.
Yeah.
But you don't have to make it, but.
Or at least not for as long and don't have the same consequences. But
Yeah.
People should reevaluate regularly. Like it's better after the fact than nothing, but ideally you do it before the trade because then you're much more confident getting into that trade. And ideally you write down the reasons because you might forget it. Like if you look at your portfolio 3 months from now and you're like, why did I buy this stock? What was I expecting? What were the price level that I wanted? The other thing is something I like to do is to exit progressively.
Okay.
Like I don't try to time the exact top. I just say, okay, here's what I think the stock will do. I'll try to get out at 50%, of my target, and 75 and 100. And I always leave a small portion in case the stock runs up. But once I hit my target, usually 80% of the position has been closed, so that I'm in profit either way. And if the stocks continue, I can still make money, but at least I don't have to worry about it. And then I don't really have to monitor that position that much because it's a small amount that could continue to grow or could be automatically sold, and then I move on to something else.
Right.
But yeah,
I think that's definitely a good idea. I have to do that a little bit more because sometimes, even if you are emotionally attached to a stock, what I've started doing is that I put in my original amount, and then if it grows, amazing, great. If I'm ever worried that it's gonna, the price is going to drop, then I'll probably take out my original, what I put in to the stock, and then whatever that profit is, I let it run up if it is. And then if I lose anything, then at least I'm not losing any money. So that's another thing to do. But I think if you are putting in money for the sole purpose of making money, then having that gradual withdrawal is probably a good idea.
And it doesn't have to be complex. Like it could be just, a Google Doc where you just write, okay, I plan to buy this stock with this strategy in mind. If it reaches this price, I'm going to sell. If it reaches this price, I'm going to sell. And so you have the thing written that you can go back to. And I find makes things easier, and you don't have to think all the time about it. And you remove the emotion from it. So that's the number one thing that gets in the way of people is the emotional aspect. Yeah, we all will get it, which is why, if you have a process, it's easier to follow, and you don't have to constantly doubt and say, am I doing the right thing? And should I really sell when everybody's buying and that kind of thing? But that's what can help you make consistent money. Like, because if you invest in the bull market, everybody thinks they're a genius. Because everything you pick is going up. So they're like, oh, I'm really good at this. Maybe I should put more money. But most people, they buy. When you look at the volume, I talked about this last time, but I was talking about institutional money buying stuff.
Right.
This time I'm talking about the retail. When you see the big spikes before the crash, this is retail.
Okay.
This is when they're FOMOing into stocks, and who's selling them? Institutional.
Right.
And it's been happening for the past 2-3 weeks.
Yeah. Oh.
Like they have been selling massively every day, and retail is every day buying the thing. And that's what I find scary about the short term for the stock market, is that this is always before a big crash. The last people to buy are retail investors from the institutional dumping their shares. So this is a time to be careful. It doesn't mean panic and sell everything. Just means have a plan in place and think about both the best case and the worst case and be prepared for both. But it's a sign where you're getting close to a top, because when those people in the big money doesn't believe in the market anymore, usually you're running on fumes. So
make a list, stick to your list, stay disciplined to your list, guys.
And get someone to help you if you can do it on your own. It's really hard to do it on your own. So having someone to keep you accountable, it could be a friend, it could be a coach, a mentor, or someone who can really, help you to stick to your plan. That helps, because if you're doing this alone, it's really easy to change your plan every day based on your emotion of the day and the news of the day and what you see your friends posting online and things like that. So
you might think you have an edge or like an intuition about something, but most of the time it's probably just emotional, right? Especially if you're new.
Especially if you read the news, because as I mentioned, it's almost always positive. Like they spin it because they want to sell you stuff that brings them money. So
they want you to put in money so they can do more things, right? Cool. So amazing. Thank you so much for being back here and all this valuable information. I am really excited for our
demo.
Our demo, getting all the trades right up and running on the TV. So stay tuned for that.
It's coming soon.
Nice. Okay. Thank you.
Okay.